Hi, I'm Pattu from FreeFinCal. Let's talk about Nifty Midcap 150 Quality 50 Index. A lot of people have become interested in the so-called factor investing, also known as smart beta investing. So, factor investing combines the benefits of active stock picking based on a set of formula and of passive investing. So, a factor index fund or a factor ETF is typically more expensive than a normal index fund or ETF, that is a market capitalization based passive fund, but it is less expensive than a traditional actively managed fund. So the index curators push these factor indices as a market beating option on an absolute or risk adjusted basis, and they say that it's less expensive than an actively managed fund. Now, when the indices were introduced by the NSE a few years ago, I was among the first to get excited by it, and I wrote several articles, made several videos on this, gave talks on this, etc. But my enthusiasm was quickly cut short by an industry expert. We're going to call him the anti-factor expert. He doesn't want him to be named. Uh, he pointed out that many of the factor definitions are arbitrary, and um, the stocks are cherry picked. That is, the baskets are defined in a certain way that they are basically cherry picked to produce good results with the past data. That does not mean it will work in the future. So he has written an article called Data Mining in Index Construction that's available within this link. So if you click on this link, that'll be a link inside that article. And one of the most important things he pointed out much later is that there is a significant time lag between the ideas that turn into products in the West and in India. So, by the time an idea becomes a product in India, the West had already seen such products for several years and gone through a cycle of good returns and bad returns from them. And already they've started criticizing them by the time they're introduced in India. That has happened just like he mentioned in the case of factor funds. And if you search for factor investing failure on Google, you'll see plenty of results. So, soon after the Nifty Midcap 150 Quality 50 Index was launched, I pointed out that many mid cap funds would struggle to beat it, and also added it as an additional benchmark to the Free FinCal monthly equity mutual fund performance outperformance screener. But because of his warning, when the products were actually launched based on this index, the UTI has an index fund on this, DSP has an index fund tracking this index. Then I had warned that the definition of the quality stock, and for that matter value, or for example, or even low volatility, is quite arbitrary. Low volatility has a neat definition, but it's still arbitrary to choose 50 stocks or 30 stocks or how many ever stocks. So I had cautioned that it may not actually work out. The performance may not actually work out as one sees in the back test. Now, many readers and viewers will know that I still believe in low volatility. I'm still invested in the UTI S&P low volatility index. I still have my stock portfolio, which is predominantly based on low volatility. And most of you may know that my stock portfolio for the last few months has not been doing well. But my intention with the stock portfolio is that it is to serve as an income source, as a dividend income source. I'm not too worried about returns there. But with respect to the low volatility index fund, I guess I'll have to live and learn some lessons there, because our anti-factor expert does not like the low volatility index either. So if you look at the since inception comparison of the quality 50 index, I keep writing it as quality 30, excuse me, it's quality 50 index. So if you look at the mid cap quality 50 index versus the mid cap 150, you can see, if you look at this graph, it looks fantastic. It looks like the quality 50 is always going to outperform, but that's not really true. If you look closely, you can see that during the March 2020 crash, the fall for the quality index has been higher. And again, you can see that the the drawdowns here has been higher. And if this is the graph for the last 12 years, and on this side of the arrow, that is to your left, this is the 10-year performance, and this 10-year performance, the quality index has begged the base index, the base mid cap 150 index, but all those gains have quickly evaporated in the last 2 years. And if you look at the last couple of years performance, it has been quite horrible. And as someone said, looking at this, it looks like someone has slept at the wheel. Well, I don't know why this is happening. There can be different arguments why this is, but that's a speculation. It doesn't really help us into trying to understand why this is happening. I'm not a big fan of that kind of analysis. But this is since March 2023 when the mid caps started moving up, and you can see that they have not moved up as much as the base index. So this means that investors currently holding the quality 50 index must be ready. They're already facing this problem. They must be ready for such extended underperformances. But if they still believe in the quality index, they can continue to hold. You can't keep on changing funds. I agree with that. So you looked at some data and you believed in the quality 50 index, to the mid cap quality 50 index fund to do well. Well, it didn't turn out the way you expected. That's fine. That happens most of the time with investments. There's nothing to worry too much about it. You can still give it a little more time. If you have just started investing, give it a little more time and see what happens. If it doesn't uh, turn out the way you expected, there's no shame in saying I made a mistake and choose another fund. There's no problem. Just that, don't waste time in regret, and don't clutter your portfolio with an underperformer. Give it some time. If it continues to underperform, chuck it and no, move over. Of course, the usual curse will happen. The After you quit that fund, the fund will start moving up. That you cannot do anything about. But the point I would like to make is that it is a warning for all factor investing fans, whether it is alpha, value, etc., this or that, etc. And you should be ready to handle long periods of underperformance, and your actual returns may not pan out like what the backtest had suggested.